This is Macro Horizons, episode 335, The Bond Stands Alone, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of August 4th. In the wake of the recent deluge of fundamental developments, a glance at next week's calendar reveals a desert of new information. In fact, the refunding auctions are the only highlight, and of course, the Treasury market's favorite Q-sip of mystery, bond, long bond. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, there was a wide variety of developments that contributed to the overall tone in the Treasury market. We came into the week anticipating that there would be a range break in one direction or another, given that the technical profile showed the Treasury market was coiling. We saw that via the compression between the lower and upper Bollinger Bands, and this all ended with a break towards lower yields following Friday's disappointing employment report. As for the details of the employment report, headline payrolls increased 73,000. However, that wasn't really the disappointing aspect of it. The disappointment came in the fact of the net revisions for the prior 2 months. Here, we saw negative 258,000 jobs were taken out of June and May. Specifically, June was revised down to 14,000 compared to the initial print of 147,000. Similarly, May was revised to just 19,000 compared to the 139,000 previously reported. Further within the release, we see that the unrounded unemployment rate increased to 4.248, so it almost rounded up to a 4.3. For context, this is the highest since July of 2024, when the unemployment rate on an unrounded basis was 4.253. So in short, we are starting to see signs that the labor market is not as resilient as the market had previously assumed. If nothing else, the net of this week's economic data has put a rate cut in September decidedly back on the table. Now, this shift in sentiment followed a relatively dovish FOMC statement on Wednesday, but a more hawkish or less dovish tone from Powell. It will be interesting to see how the official messaging changes over the next couple weeks. Keep in mind that on August 12th, we will see the July CPI figures, which are expected to show some upward pressure on goods inflation as a result of the new tariff schedule. The market also had the benefit of the updated Treasury refunding statement, which confirmed that the Treasury Department intends to keep auction sizes stable for at least the next several quarters, which, in practical terms, means that the first time that we are likely to see auction sizes increase will be the second half of 2026 at the earliest. We also learned that the Treasury Department has decided to increase their liquidity buybacks. The increase was by $8 billion, going from $30 billion to $38 billion. However, there was also a targeted shift to double the number of operations that occur further out the curve. As defined by the Treasury Department, it's effectively the 10-year sector and out. At this point, there is no question that the Treasury Department is conducting a stealth operation twist to keep longer-dated yields lower. The question that this raises is, will the Treasury Department need to continue to increase the size and frequency of buybacks further out the curve, or is this simply a one-time adjustment? Our assumption is that in the event that yields further out the curve don't remain comparatively low, that the Treasury will decide to, once again, increase the size of these liquidity buybacks. There's an obvious uncertainty that this raises on the credibility side, i.e., will the market demand an increasing amount of term premium if the perception is that the Treasury Department is trying to more actively influence the outright level of yields than it has in the past?
Well, it was always going to be a big week, maybe one of the biggest weeks of the summer in the Treasury market. We got the refunding announcement, an FOMC decision, and then, most importantly, a payrolls report that came in below expectations at just 73,000 jobs added in July, with more troublingly more than 250,000 in two-month net revisions over the past 2 months that paints a much softer labor market picture than was previously assumed to be the case, as recently as Powell's press conference on Wednesday. And the market's reaction in this context followed intuitively. A meaningful rally that brought 10-year yields back to 425, an impressive steepening of the curve with 5s/30s back above 100 basis points, and September cut pricing that is now back above 20 basis points, as the market contemplates the likelihood that maybe the Fed will in fact need to cut rates next month.
And it was an interesting setup because a lot of market participants had been anticipating at some point the labor market conditions beginning to deteriorate. But it had simply taken so long that many people either closed or were stopped out of those positions. And as a result, we went into the payrolls report with a relatively balanced market and limited conviction. When the headlines hit, it became very clear that people were chasing the move, and they're chasing a move that many had been expecting at some point would come to fruition. And what will be interesting is to see how the combination of July's CPI, August's payroll report, and then August CPI set the market up for the September meeting. We'll also have plenty of Fed speak between now and then, as well as the Jackson Hole events, all of which are consistent with our view of the week just past as being a tone-setting event and, for all intents and purposes, the last week of trading this summer.
And as has been thematic throughout the course of this cycle, really what the Fed and the market has been grappling with is just how restrictive monetary policy is, or whether monetary policy at these levels is restrictive at all. What July's jobs numbers exemplify is that whether it's the uncertainty brought on by the trade war or the fact that rates have been, by most measures, in restrictive territory for quite some time now, we're now starting to see a demonstrable impact on the pace of hiring, and additionally, let's not forget that this week we also saw a JOLTS report that showed a modest, but nonetheless, decline in labor demand, and drop in the quits rate, which shows that firms have less need for workers, and workers are less willing to leave their jobs in pursuit of other employment. Take this with what we saw in the labor differential within the Conference Board Consumer Confidence Series that showed consumers see the spread between jobs plentiful and jobs hard to get as the narrowest since the pandemic, and now we have a handful of data points that show that the labor market is indeed starting to show signs of stress. Now, does this mean it's an inevitability that a sharp recession is right around the corner? Not necessarily. But as the FOMC continues to evaluate the distribution of risks around employment and inflation, this week's new information certainly should add a bit more caution around the employment side of that equation.
One of the most interesting aspects of the employment report was, as you pointed out, Ben, obviously the downward revisions, but the magnitude of those revisions was the second largest on record, the record being May of 2020. So for all intents and purposes, excluding the pandemic, this is the largest 2-month downward revision. We're certainly cautious of the risk that one looks at a single report and says, aha, this is what we've been waiting for. Now the Fed's going to begin cutting in September. But the nature of the revisions means that we actually now have 3 non-farm payrolls report that are consistent with softer jobs growth, and when putting it in the context of the Fed's dual mandate, makes a very compelling case for an insurance cut in September. That should then start the conversation about whether the Fed's 50 basis points worth of rate cut messaging in the June SEP might have undershot the mark. Because in the context of the softness of the employment landscape, if they begin in September, there might be a very compelling case to then go in October as well as December, which gets us very quickly to 3 cuts this year and certainly adds at least a modest amount of credibility to Trump's ongoing criticism of Powell's wait-and-see stance.
And further to that point, Ian, there's nothing that necessitates September or one of the other 2 meetings this year needs to just be a 25 basis point cut. Because as we've seen in the past, in the event we see another ugly jobs report and concern about the labor market grows even more pronounced, there's nothing that would prevent the Fed from cutting by more than 25 basis points. And especially from the market's perspective and what we currently see priced in terms of policy easing, there's certainly a case to be made that there should be a degree of premium in excess of 25 basis points priced in at subsequent meetings this year, or at least in aggregate over the course of 2025, more than what was laid out in the June dot plot in terms of the projected easing that's going to come later this year. This then introduces the risk of a feedback loop we've seen over the course of the last several cycles, which is that if the market begins easing for the Fed and bringing market rates lower by not following through and delivering on the cuts that the market is expecting, the Fed runs the risk of tightening financial conditions. Now, back when there needed to be more pressure exerted on inflation, that wasn't really a problem. Tightening financial conditions was exactly what Powell was pursuing. But now, if in fact we start to hear a more significant tone change from Powell or other members of the FOMC besides Waller and Bowman, that maybe policy is too restrictive, then they certainly won't want to be delivering a tightening impulse in terms of financial conditions, given where the market might be priced in the run-up to the September meeting.
Bowman and Waller's dissent at the recent FOMC meeting certainly appears to have been the right decision. If nothing else, they have confirmed that they are the more dovish-leaning committee members at the moment. Now, we haven't started to hear any rumblings about an intermediate rate cut yet, but we wouldn't be surprised, given the dearth of economic data on the immediate horizon, to see this potential at least addressed by market participants and pundits.
And we've talked a lot about the jobs report, given that that was the most important thing that happened over the week just past. But we also got the long-awaited update on Bessent's borrowing plans and buyback aspirations via the refunding announcement, which showed an increase to liquidity support buybacks to the tune of $8 billion, growing to $38 billion from $30 billion over the last quarter, concentrated in the 10 to 20 and 20 to 30-year sectors of the curve. Now, this was more or less what the market was expecting in terms of the changes to the buybacks, and while it might not be a true operation twist, it certainly sort of looks like that, if in fact these larger purchases are going to be funded with heavier bill issuance as the refunding documents suggested, along with the fact that the language within the refunding statement itself retained the quote-unquote next several quarters language that has been in place over the last 6 quarters in terms of the Treasury Department leaving coupon auction sizes unchanged. At this stage, it's become very clear that Bessent is going to be extremely reluctant to begin increasing long-end auction sizes anytime soon, and the absolute earliest we could envision this taking place would be in the middle, or frankly later part of 2026, and it's certainly not off the table that we could make it through the entirety of next year without seeing long-end auctions grow. So this means that from the current departure point of right around 21% of the overall market, we're anticipating to see bills climb back toward that 23% level that was reached following the volatility of the pandemic, and frankly growing beyond there to 25% or even something slightly larger is not out of the question, because after all, even if Powell's going to be cutting in September, rates in the front end are still high and attractive enough to bring in demand, and so we're less concerned about appetite for bills, which should give the Treasury Department comfort in continuing to pursue a borrowing program that's more heavily focused on the front end.
Interestingly, on the topic of longer-dated borrowing in the Treasury market, our pre-NFP client survey asked the question, what's the next move for the 20-year auction size? Will it be increased or decreased? The majority of respondents said that it would be decreased. Indirectly, we suspect that what the market is responding to is the ongoing struggles that that particular benchmark has seen, as well as the fact that the surrounding benchmarks, i.e. 10s and 30s, can be increased while leaving 20 stable, and then eventually, when auction sizes decrease at some day in the distant future, that 20s would be brought lower to keep the relative spread between 20s versus 10s and 30s intact.
and that's certainly an important shift that's taken place as recently as the last 6 months. Coming out of the election, higher term premium, larger deficits, higher long-end borrowing was a critical driver of the bear steepening thesis that really drove the negative sentiment toward the long end of the curve, and instead what we've seen is the administration take an explicit stance against that idea, given the desire to keep longer-dated yields low and not run the risk of testing appetite for longer-dated treasuries when the bill market will do just fine. And so as we think about the impulse for an extension of the steepener from here, it's probably not going to come from the Treasury supply side, and instead will need to be far more of a Fed-driven story.
But at some point, as Besant surely knows, the bills come due.
The ones less than 1 year to maturity, anyway.
You mean the football team?
This year is our year.
In the week ahead, there is a remarkable lack of economic data, and as a result, we wouldn't be particularly surprised to see relatively choppy price action. So, for context, the highlight is ISM services for the month of July, where the market sees this gauge of sentiment in the service sector at 51.3, comfortably above the 50 threshold, but nothing that will change the dimmer outlook that resulted from the payrolls report. We also have the $58 billion 3-year auction on Tuesday, followed by the $42 billion 10-year auction on Wednesday, and then capped by the $25 billion long bond auction on Thursday. Given the increased economic uncertainty, we're generally constructive on all of these auctions, and we'll also note that chatter about a buyer's strike in treasuries has subsided, and that follows a string of reasonably successful auctions that have occurred since Liberation Day. With the August 1 tariff deadline now passed and Trump's new schedule of reciprocal tariffs now in place, we suspect that auction demand for treasuries will no longer be considered a wild card by many market participants. Moreover, recall that the Treasury Department has reiterated that it will be at least several quarters until they consider increasing auction sizes, a fact which in and of itself is supported for the upcoming auctions. From a broader perspective, we remain constructive on the Treasury market. We came into this year with a call for 10-year yields to end 2025 at 3.85, and we're retaining that call. We think that the shifts that have occurred in the labor market do leave a September rate cut on the table, and a softer labor profile combined with a slower pace of consumption that was seen in Q1 and Q2 point toward forward disinflationary pressures. This dynamic also helps the FOMC justify viewing the tariff-related reflationary pressures as a temporary, one-time adjustment that is unlikely to translate into sustainably higher inflationary pressures going forward. Now, it goes without saying that this is a key unknown, and an unknown that has been contributing to the FOMC's reluctance to begin the process of normalizing rates. In light of the trajectory of jobs growth during May, June, and July, the case is growing for the FOMC to deliver an insurance cut in September, if nothing else. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And for anyone who waited until the very last minute to vote in this year's Extel survey, great news, polls are open until Sunday evening. And remember, a vote for BMO is a vote for a podcast that moonlights as a treatment for insomnia. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.